Today we are looking at 4 undervalued, deeply discounted stocks to buy now. We're going to take a look at the historical performance of each company. We're going to run through and look at their dividend safety, as well as some very important financial metrics you need to understand for each company. And we will be running them through our stock valuation model, getting to our intrinsic value and finding out our acceptable buy price with our margin of safety for each of these companies. So today we are signing off our first deeply discounted dividend stock as Texas Roadhouse. Now, for those that don't know, it is an American steakhouse chain that specializes in steak in a Texan and Southwestern cuisine style. Now, they are up around 21% year to date. They are towards the mid to upper end of the 52-week range, and they do offer around a 1.95% forward yield. Now, investors who have been holding these shares for over the last 10 years would be up an incredible 302% without those dividends reinvested. So when we take a look at some of the metrics, we first start off with their dividend safety, score of 80, making it safe, with a market cap of 7.52 billion, so it is a mid-cap company. Now, when we take a look at some of their recessionary metrics, well, they didn't pay a dividend in 07-09, so there's no comparative data. However, they did have plus 3% recession sales, which if you are a regular viewer, you know this is above the average growth of companies in the S&P 500, which was negative to a significant degree. They also beat them in terms of the return, with a recession negative 33% return versus the S&P's negative 55%. Now, we absolutely love their dividend growth, 20% double digit this year in February, 17% over the last 5 years on average, and 18% over the last 10 years. Absolutely incredible and well above that minimum 4% inflation rate that we advocate on the channel. Now, in terms of dividend yield theory, it states that the company is undervalued when the current yield sits above the 5-year average. So what we see right now, based on this theory, is that it is currently reasonably valued. But remember, we never look at any model in isolation and draw conclusions towards the end. And we see their forward PE roughly in line with the 5-year average of 22.2. Now, we also see the sector PE significantly lower at 14 versus 22. And as mentioned, is trading towards the mid to upper end of the 52-week range. Now, regular viewers on the channel do know that we tend to focus on the free cash flow, as the earnings is susceptible to manipulation by management through accounting. And on the free cash flow, we look for 60% or lower, as we believe it then means management have the ability to offer us those double-digit increases we love to see on the channel. So what we see here for Texas Roadhouse is significantly below 60% consistently year on year, with the last few years in fact around 30 to 50%, although do note 2023 is expected to come up slightly higher. Now, free cash flow per share, 89 cents in 2013, 3.93 in 2022, so they have grown that free cash flow by around 4 times over the last 10 years, which is very positive to see. And we always love to see on the channel when we see the sales growth, double-digit increase every single year. Very positive. Yes, 2020, negative 13%, but you could justify the main reason for this drop due to COVID, with restaurants closing and therefore not having the consumers to come into their restaurants. Now, how does that compare numerically? Well, 1.42 billion sales in 2013, 4 billion in 2022, so more than double growth on the top line over the last 10 years. Very, very strong. And on top of that, you are getting a company that does share buybacks, putting excess cash into your pocket, 71.4 billion in 2013, 67.9 in 2022. Now, ROIC, do remember it is one of our 7 golden dividend metrics. And what we love to see is 10% or more. It gives us faith that management are able to effectively allocate their capital. And for Texas Roadhouse, again, bar the COVID year, it has been well above that every single year. So that is very, very positive. Now, one thing with the restaurant industry you do find them struggling on is their margin. So the operating margin is below the 16% that we typically like to see, and it is, we can see on the free cash flow margin, fairly inconsistent but slightly better in terms of the consistency around the 5%. So do note this when you are looking to invest in restaurant companies in the industry. Now, net debt to EBITDA, this does directly correlate to the dividend safety. Below 3.5 is what we target, with these showing the number of years it would take the company to pay off all of their debt net of cash on hand. 1.1 in 2022, expected to be fairly similar in 2023. So we can see that dividend not only is safe, but they do have a very strong balance sheet. So now when we take a look into the stock valuation model, now typically if you do watch the channel, you know we end up going into every single model, Graham's valuation, we do the multiples valuation, the dividend discount, the discounted cash flow to get to our intrinsic value. Now for today's episode, we'll jump straight into the output to get to the intrinsic value. And if you know, on this channel, we don't always use all models as they aren't relevant for every company, and we do discuss this within each video. So the intrinsic value for Texas Roadhouse is coming to $141 with the current price at around $112.61. So we typically start off with the margin of safety of 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data, which would mean it's acceptable buy up to $127. Those looking at 15%, it would be a buy up to $120, and those looking at 20%, it would be a buy effectively around the current trading price. So based on our estimates and judgments for Texas Roadhouse, you are getting a 20% margin of safety. Now, what do Wall Street say? Well, they believe the share price to go higher than the current trading price by around $20 per share, and we can see that's slightly lower than our intrinsic value. So whilst they do see some significant upside, they do believe the 12-month period it won't hit the intrinsic value we have calculated. So that is the first undervalued stock that we have that we believe is a buy right now. Moving on to the second stock that we believe is discounted is Texas Instruments. Now, Texas Instruments design and manufacture semiconductors and various integrated circuits, which they sell to electronic designers and manufacturers globally. Now, they have struggled down 6% year to date, trading towards the mid to lower end of the 52-week range. The current yield on offer is 3.4%, and investors who have been holding the company over the last 10 years would be up again a very positive 257%, and we can see it did hit on the back end of 2021 their peak at around $200. So when we take a look at Texas Instrument, they have a dividend safety score of 90, making it very safe. Market cap $139 billion, so they are a mega cap company. Now, in terms of recessionary metrics, they increased the dividend during the 07-09 recession, negative 26.9%, so below the average growth of companies as we discussed earlier, and we can see they did underperform the S&P by negative 59% versus S&P's negative 55%. Another strong company for dividend growth. Yes, it was a slightly mediocre one this year with September's increase coming in at 4.8%, roughly around the inflation rate that we do like to get higher than. Although if we do take a look, the last 5 years, 17% every single year on average, and over the last 20 years, 22%. So that is very, very strong. As a dividend growth investor, it is lovely to see. And they have been paying increasing dividends over the last 19 years. Now, dividend yield theory, as always, we see a sign of undervaluation as the current yield sits above the 5-year average. And we do, interestingly, see the forward PE tell a slightly different story with slightly higher number than the 5-year average of 23. When we finally look at the sector PE, it is roughly in line with 24.3 of TXN versus the information technology sector of 23.4. Now, looking at the free cash flow, remember we do like to see below 60%. Over the last 10 years, whilst it has been below 60% for the large part, it has started to creep up, and we do see 2022 coming to 73%. Now, 2023 is expected to go above 100%, so this may be one ratio that you do want to keep your eye on, as it will affect that dividend safety. Now, free cash flow per share, very positive to see the growth they've had from 271 in 2013 to 647. But again, do note this is expected to come down, so do take a look at that forward guidance. On the sales growth, 3-7%, as a reminder, we can see these slight inconsistencies, which you could put a lot of that down to the cyclicality of the semiconductor industry. And when we look numerically at sales, they have nearly doubled their top line over the last 10 years, from 12 billion to 20 billion. Another positive sign is they do share buybacks from 1.11 billion shares outstanding in 2013 to 926 in 2022, returning that excess cash to your pocket. ROIC, very, very positive to see the last few years in the 40%, so that is very strong. And even though the trading 12 months has dipped, it is still well above that 10% minimum we do target. Margins, absolutely phenomenal. Operating margin, well above the minimum 16%, as well as that free cash flow margin, although we are expecting a slight dip in 2023 from the 30% we saw in 2022. Now, net debt to EBITDA, now fantastic, 0.01, meaning it wouldn't take them that long at all to pay off all of their debt net of cash on hand. Yes, it is expected to increase very slightly in 2023, but still showing a very strong performance and a very strong balance sheet that the company has. And I personally see no worries in terms of that all-important dividend safety. Now jumping into the stock valuation model, and as always, if you do enjoy the content, value is being provided, do smash that like button, hit the subscribe and bell so you are continually notified of these videos as they drop. So margin of safety, remember we put that down to 10%, so it would be a buy up to $163 if you believed that this essentially deserved a 10% margin of safety. At 15%, we can see this is still essentially a buy. So what this means right now with Texas Instruments, if you were to lock in a margin of safety of 15%, this would be a buy right now. And Wall Street, they effectively believe the share price will increase to around $174 over the next 12 months. So they do believe there to be some nice upside to Texas Instruments. We then move on to the third discounted stock, which is Target Corporation. Now, this is an American retail corporation that operates a chain of discounted department stores. Now, year to date, they have suffered, down 13%. They are trading towards their mid to lower end of the 52-week range, and they do offer a yield forward-looking of 3.35%. Now, investors who have been holding this company over the last 10 years would be up around 106%, and we did see hit its peak towards the summer of 21 at around $260, so it is currently trading for half of the all-time high over the last 10 years. Now, when we take a look at that all-important dividend safety score, we see a score of 90, making it very safe. Market cap 61 billion, so it is a large cap company. And for those that see a recession around the corner, well, they increased the dividend and they had relatively flat sales during the recession, but they did unfortunately underperform the S&P with a negative 61% return versus the S&P's negative 55%. Now, they did have a very, very poor increase in June of this year at 1.9%, but if we do look at the average over the last 5 years, double digits at 10%, the last 20 years, double digits 15%, so very, very strong to see. And for those that didn't know, they are a dividend king, as they have been paying increasing dividends over the last 50 years or more. Now, dividend yield theory, we can see a sign of undervaluation at 3.35 versus the 5-year average. Likewise, forward PE backing this up with a forward yield below the 5-year average. And when we compare it to the sector PE, it is slightly lower at 14.5 versus 18.7. Now, importantly, when we do take a look at that free cash flow, we do note that it is below 60% from the majority of the last 10 years. However, due to their performance, and they did unfortunately have a poor performance in 2023, we do see that effective negative 121%, but it is expected to climb back up to its expected and normality levels in 2023. Free cash flow per share, $7.30 in 2014, $10.40 in 2022, and again it did dip due to poor performance in 2023, although it is expected to rebound very nicely in 2024. Sales growth, again, a mix. We do like 3 to 7%, and we can see from 2014 to 2020, it had a mediocre performance, but over the last 2 years, from 21 to 22, it did see some strong double-digit increases before coming back down in 2023. So numerically, what this essentially is 71 billion to 109 billion in 23. They also do share buybacks, which is a common theme of the stocks that we have run through, from 642 million to 465 over the last 10 years. ROIC, above the 10% we look for, although do note in 2023, due to the poor performance, it has come down to 12%, but it is again expected to go back up due to the trailing 12 months at 15%. Margins, again, consumer retail is very similar to the restaurant industry. They do struggle with the margins, and we can see they haven't hit that 10% that we like to see on average over the last 10 years. And 2022, it did signal a very nice 9% in comparison to the previous periods, but we do see 2023 dropping. Very similar story on the free cash flow margin as well. Net debt to EBITDA, though, again, a common occurrence with these companies that we are analyzing today. Net debt to EBITDA below the 3. Yes, it has increased from 2022 to 2023, but still at 2.4 below the 3. And it is expected again in 2024 to come down. So we do expect that dividend to be very safe for Target. Now, analyzing Target on the stock valuation, and don't forget, if you do want to grab a copy of this model to run companies of your own, I'll get to the acceptable buy price of companies you own. You can click on the pinned comment below, and it works as well for companies that you do want to analyze that you are interested in buying. So we have an intrinsic value for Target at $157. We'll start off with our margin of safety at 10%, and that gives a buy up to $141. If we extend this to 15%, again, a buy pretty much near the current trading price, so you are locking in a 15% margin of safety. Now, what do Wall Street believe? Well, they see some nice upside to the current trading price. roughly in line with our intrinsic value over the next 12 months. So they do believe as well you are locking in a rough 15% margin of safety. Now, we move on to the fourth and final undervalued stock, which is ASML. It's specialized in the development and manufacturing of photolithography machines, which are used to produce computer chips. They have had an interesting journey this year. They are up 26% year to date, trading towards the mid to upper end of their 52-week range with a yield of just below 1%. Now, investors who have been holding this company over the last 10 years would be up a phenomenal 640%, and this isn't even taking into account the fact that it hit its peak of around $870 towards the back end of 2021. Now taking a look at the dividend metrics, and as always, if you do enjoy the content, value is being provided, just take a second to smash that like button. It really helps the channel grow and for me to continue to put this content out. And do subscribe and hit the bell if you haven't already to be notified of these videos as they drop. So dividend safety score coming at 82, making it very safe. Market cap 273 billion, so it is a mega cap company. Now recessionary metrics, unfortunately they did cut the dividend during the last recession. Very poor sales at negative 56, which was well below the average growth of the S&P, which was negative but to a much smaller degree. And they had a recession return which was in line with the S&P 500 at negative 55. Again, common occurrence of these stocks we've analysed today, very strong dividend growth. However, 2023 has been slightly turbulent. We do see, however, a 5.8% increase for ASML in July of this year. 33% over the last 5 years, 27% over the last 10 years, very, very strong. And they have been paying increasing dividends over the last 13 years. Now, dividend yield theory, what we can see, they do seem to be undervalued with the current yield above the 5-year average, 0.88 versus 0.47. And we can see a slightly different story with the forward PE at 35 above the 5-year average of 32. And when we compare the sector PE, they are sitting at 35, which is above the information technology at 23. Now again, free cash flow payout is what we tend to focus our time and energy on. Below 60%, or you could push it to 50% for the semiconductor. Again, well below that year on year, which is why we do see those nice double-digit increases. And we see 2022 at 32% and expected to be slightly lower in 2023. Free cash flow per share was some phenomenal increases, 196 in 2013, 18 in 2022. So this is a fast-growing company, and that is also seen with that double-digit increase to their top line nearly every single year over the 10-year period. Numerically, this translates to 5 billion of sales in 2013 and 21 billion in 2022. So more than 4 times, or roughly 4 times increase to their top line over this period. Again, shares outstanding, another company that does share buybacks, 433 million to 398 over the last 10 years. Now, ROIC, again, you should be picking up when we are analysing these stocks a few commonalities of why we are picking them, why we do like to invest in them regardless of their undervalued state or not. Above that 10% with the last few years in the mid-40s. Operating margin, free cash flow margin, phenomenal above those minimums that we target on both margins. And when we look at the net debt to EBITDA, you can't really get a much better metric than that. 0, they have a very strong balance sheet, very safe dividend, and it wouldn't even take them one day to pay off all of their debt net of cash on hand. Now we move on to the valuation for ASML, and don't forget, it's really helpful if you smash that like button. It lets me know you're loving the content, you want more of the same. Hit the subscribe and bell so you are continually notified of these videos. And as always, if you do want to grab a copy of the valuation model to run companies of your own to get your own acceptable buy price and intrinsic value, then do click on that pinned comment below. So our intrinsic value for ASML is coming to $771. Margin of safety, again, we start off with 10%. It is a buy up to $694. So you could argue right now for ASML, you are getting a 10% margin of safety. Those who are looking for a slightly larger margin of safety at 15% would be around 655, and those who want even more would be around the 617. Now, what do Wall Street forecast? Well, they believe the share price to go slightly higher, in fact, than our intrinsic value, so they do believe there to be some very strong upside. And don't forget, you are locking in right now, based on our estimates, a 10% margin of safety. As always, do let me know your thoughts on the videos as you go along, whether you liked the video or whether you had any questions in terms of undervaluedness. And let me know if you have been adding any of these shares throughout the last week or so. Let me know as well if you have been selling any of these for any reasons. And finally, if you do enjoy the content, just smash that like, hit that subscribe and bell, and do grab a copy of the valuation below if you are interested in playing around with companies you're interested in or your own portfolio. As always, have a great day, catch you on the next episode, and take care.